Good morning, everybody. My name is Dave Finale, and this is Real Estate Talk TGIF. And we are really happy to have, and I hope I get my camera correct today. I just got some new things we're working on here. Anyway, so it looks a little crazy, but we'll get it right sooner or later. Let me just do that real quick. I don't know why that's not doing that. Okay. Oh, I know why. Hold on. Sorry, making big mistakes here. We're going to do this. We're going to do this right. Hold on one second. Wow, I tell you what, new equipment, I messed things up really badly today. Anyway, here we are. I'll get it right sooner or later. I am so sorry, Baret.
All good.
We are here. This is Real Estate Talk TGIF. Welcome to episode number 350. This is 346 weeks in a row we are here. And I want to welcome Baret Kechian. Baret is with Loan Depot, and he is, to me, one of the most extraordinary mortgage people I've ever worked with and met simply because he's got the answers. And that's one of the things we're all looking for is the answers, right? What does that mean? It basically means that if you've got an issue, he can help you. And we're going to get right into that in a couple of minutes. But first, hit the video, Nelson. Real estate agents want to acquire clients consistently to grow their business and income for that great lifestyle. This broadcast brings you the best people in the industry to support that quest. This is Dave Finale, and I'm here to bring you the Real Estate Skill Builder broadcast, Real Estate Talk TGIF, brought to you by Real Estate Skill Builder and Align, your premier real estate solution. Good morning, everybody. My name is Dave Finale, and this is Real Estate Talk TGIF. And again, I am having some issues with technology here today, but we're going to keep going with what it is. And I apologize for the way it looks, but we're going to keep going. Anyway, so Baret Kechian. Baret is, and I'm going to read through his thing. He's a national top producing mortgage originator. He's got 30 years of experience in mortgage lending and is consistently ranked among top originators in the industry. In 2040, he ranked number 8 nationwide, top dollar volume. He's dedicated to keeping real estate professionals informed and delivering exceptional service, drawing from his experience with his own experience as buyer and seller. Baret, welcome to the broadcast today. Sorry about the technical BS we're going through. It worked right before we came on, and now there's an issue. So anyway, everybody gets to see what my room looks like and behind me. So here we are. Thanks so much.
Yeah, thanks for having me. No filters here either. This is my house. I'm talking to you from, so all good.
That's cool, man. So before we get into it, what I want to do is I'm going to ask you one question.
Yes, sir.
And the question is, what does TGIF stand for?
I think it's thank God it's Friday, but maybe it's something else.
Well, actually, you're really close. Most people get it wrong. I'm sorry, 90% do. It's thank God it's finale. And here we are. It's I mean, it's not that hard. I mean, people think it is that hard. I don't know why this is doing this to me, but anyway, there, we're just going to keep it right there. Okay. So anyway, here we are. Talk to me about where you came from. I know a lot of people, get into the mortgage business, get into the real estate business from, a place of, well, you know what, let me try this, or I like that idea. So, but you got into it right away after school. Is that right?
Literally a week out, Rutgers University. One of the main jobs I can get that paid the highest salary to be in a mortgage, and by $1,000. And I decided, all right, let me give this a shot. Didn't even know what a mortgage was when I started at the ripe age of 22, and 30 years later, here we are. So
that's pretty cool because you got into it right away.
Luck, to be honest, it was luck. I learned kind of everything, on the job in a way. Champion Mortgage, who housed some of the top loan officers now, we see the number 1 loan officer in the country actually came from Champion. So we definitely all have interesting backgrounds. And they definitely sprouted a lot of people over the years before selling off the key.
So 30 years is a long time. Tell me about your journey in the mortgage industry from when you got started to now.
Yeah, I mean, the early on it was like those companies were very subprime type companies, and you just didn't know different or better. And then once I got into a prime type situation where you're doing real mortgages, now you can get referrals and people are happy to tell you about their friends and all that. So at maybe 26 years old, I was running a branch with someone, and eventually I took over by myself, and have been running a branch ever since. I will say that, the management part of running a branch is not as enjoyable to me as working with clients and actually doing mortgages. So I have people now on my team that handle a lot of the branch manager, maybe, part of the responsibilities. I'm just there to, kind of, motivate, share ideas with my team, lead by example, because I'm in the, trenches with them. So as things are going tough, I'm right there with you. I understand it. I'm not out golfing and then barking orders at people. So I think that's, been my style, is just, from experience and leading by example.
Yeah, I understand the point about, having to, you're actually running the business of the business that you love to do, right? And that can be really difficult, especially when you want to produce yourself. So we talked about a whole bunch of stuff the other day. I mean, your basic niche has been condos, right? And
it got me to where I am today. Yeah, so condos definitely helped us tremendously in picking up a ton of market share. Moving to Hoboken years ago, certainly, you had to know condos. So we just kind of made it our goal to just become experts at it, and try to learn every little nuance you can learn about condos. Every legal workaround that you can do to get a condo approved. Know all the rules, and if you know all the rules, then you can use those rules to your advantage. Within what they set. So yeah, that helped us a ton.
So one of the things that I think the most important thing that we're hearing a lot about today is interest rates, right? I mean, it's simple. I mean, you're the loan guy, and what are the rates going to be? When are they going to come down? I mean, look, it's kind of boring to hear me say anything like, I remember I first got into the business when rates were 18 to 20%. Nobody really wants to talk about crap anymore, right? But what it is these interest rates aren't as terrible as everybody thinks they are, but they were used to another number.
That's
so
right.
What is important today, Baret, about the interest rate that we're working with in the local markets?
I mean, I guess you just have to know it's not forever, right? Like if you can make the cash flow situation work, and you've been renting because rents are going up just as much as prices are going up, then if you buy something today, just know that this will be your worst case scenario. Down the line, you'll probably refinance these loans probably 3-4 times over the next 5 to 7 years. We just don't know the exact timing of it, but a lot of the predictions we've been seeing through Mortgage Bankers Association, Fannie, Freddie, and even some of our internal people have been saying, like, we expect rates to go back down into like the low 6s by the end of the year, maybe fourth quarter. And we've been surprised. Like, look at August, September. I mean, out of nowhere, they announced a couple of cuts, and then we kind of thought they were going to get into that cutting stage, and rates freaking plummeted. We got back down to like in the 5.8, 5.7, like those types of numbers, and the entire industry got excited. Buyers were coming out of the woodworks. Let me redo my pre-approval. I'm ready, and selling it, and then next thing it was gone very quickly. So inflation kind of reared its head again. Scared some people, but a lot of the numbers we're seeing might be a little behind. A lot of what we're seeing maybe in employment, the amount of jobs that are available, the amount of time unemployment is lasting for certain people. Maybe some of the inflation numbers could be a little overdone. I saw a number yesterday that said, the housing inflation was at like 4%, but you look at Redfin, you look at Zillow, they're saying only 1.5% from year over year for rents going up. And so to me, like, if once these numbers kind of catch up and they realize that the economy is not flying, I think you're going to see rates certainly come back to a normalcy. But what's normal anymore? I mean, we're not going back down to 3. We're not going to 2.5 like we did during COVID. But I think we had a very solid, stable, where either side didn't have a huge advantage in 2019, and rates were between 4 and 5. 2018, like those years, there was people buying, people selling. The normal ecosystem, you buy a condo, you get married, you have a kid, then you sell that condo to somebody else who needs that condo, and you buy a house. Right. Now you're sitting on a 2.8% rate. To go from 2.8 to 7 seems impossible. And so people are staying. People are not selling their place. They're renting, and giving us the shortage of inventory that, all my real estate friends are complaining about.
Yeah, what's interesting is we talk about rates, right? And I made this statement when I first got into the business a minute ago. But I want to talk about, I mean, we went from 2005 and when everything was like going crazy. And if you were one of those people that bought in 05 and then had to sell a few years later, that's too bad. Guess what? I'm one of them. That wasn't the first time for me. That was the second time for me because I bought in the 80s and sold in the early 90s. So I got screwed twice. Anyway, the point I'm making is that as we went through 2008 to 2012 to 2015 to 2018, things really started, in my opinion, to normalize, right?
Yeah.
And then we got hit with COVID, and then everything changed. Do you see? I mean, look, obviously we have a problem with new construction. We have a problem with a lot of other different things with supply and demand. Do you see us getting to a normalcy of our own kind in the next year or so?
Maybe not the next year. I think rates would have to come down a little bit more for like that normalcy, maybe closer to 5%, just because people that are sitting on these rates have to feel good that they're going to be able to get something they can afford in order to put their house on the market. And until then, you're not going to see the inventory pick up because there's not a lot of new builds going on. Look at us around in Hoboken. I mean, there's only so much space, right? Like, how many times can you redo a building? So there's not any major projects happening other than maybe one that's, sizable, condos coming on the market. And so I think until those resales pick up, which probably, maybe even 5.5, I've talked to Brett Secor on this, and we've kind of said it, 5.5 would trigger some people. And I think selling will start and then they'll feel better. Like, I think somebody would sacrifice a 3% rate for 5.5 if their family was truly uncomfortable in their current home with space. But 3 to 7 just seems like it's, hitting some people the wrong way. So I'm finding that that's the numbers.
Yeah. So
at some point they will stabilize. You'll see prices.
When we talk about the rates, right? And you're talking 5.5 is the number. I kind of think low 6s is going to start things because of the impatience of people.
It will.
Basically, you look at us that we're consumers, right? So I use 2005, 2008 again. One of the things about 2005 and 2008 was it was probably one of the lowest times of savings deposits in a very long time, and then that built up through 2012.
Yeah.
And now we're back to high credit card debt, right? That we hadn't seen, I think, since way back then.
100%.
Now we're starting to see that again. I mean, everybody talks about a cycle. I don't think that's a cycle. I think I think we all got hoodwinked by the money that was given out for free during COVID, and we started a cycle. Now we've got a lack of inventory, and that only is going to be increased by what you said, by the lower interest rate, people being confident they can afford their next home.
That's right.
What are the alternatives? I mean, not alternatives, but what can someone else do if they have a higher interest rate but they need to move? Let's face it, people are going to move. People are going to have the requirement of moving, whether it's family, whether it's new family, old family, downsizing, etc. Is there other methods to doing that?
Yeah, I mean, look, you can always do some things in the short term. You can do build in some temporary buy downs to your interest rate to make cash flow easier in the first couple of years, as long as you're confident that rates will eventually come down to refinance permanently. You can look at some adjustable rate mortgages, 5-year, 7-year adjustable. It's a good program if it saves any money over the fixed. They're not available in every instance. And again, it's not going to take you from 6.5 to 4. It's going to take you from 6.5 to 6.1 or 6. But every little bit counts. So like what I'm telling people is, look, get the lowest number that's physically available for you now. If it gives you 5 to 7 years, it may as well be a 30-year fix. There's no way this lasts that long, in my opinion. I think you're going to see, over the next couple of years, we'll certainly see a break. And like you said, I think low 6s now will look great to people, especially once they saw that that's not permanent anymore. Because everybody last year, when we called them to refinance, some people were like, oh, yeah, you know what? They're going to keep going down. I'm going to wait. And the people that took advantage are feeling very happy right now because they saved the boatload. Yes. And the ones that waited, got greedy, are lost out. They went way back up. So now I think when they hit 6.1, you're right. I think it's going to trigger a ton of buying activity. I'm not sure about the selling activity yet. And we'll see about that with inventory. And you're totally right on credit card debt. I mean, there is a ton of credit card debt in the country. I'd say the only difference, a major difference between now and 2008, equity. I mean, there is more equity right now in the U.S. than there has ever been, ever. The problem is people can't access it because unless you're taking a high interest rate home equity loan, which, prime is sitting over 7.5%, and then, or you're refinancing an unbelievably low mortgage in most cases and refinancing it up to 6 or 7, you're not really able to use your house as a piggy bank anymore. And so you have a lot of people paying some really expensive interest rates on consumer debt. I think that's going to come to a head eventually. And that may be the thing that finally pushes rates down and shows everyone the economy is maybe not as good as it is. I think a lot of people were living on those credit cards the last few years, and that was keeping everything up in terms of, oh yeah, look at the economy. Everybody's spending money. They're spending money they don't have in some cases. Now, that's parts of the country. I got to say, like where we are, East Coast, Hudson County, we're not seeing it as much. But there's a part of the U.S. that is calling Loan Depot's corporate every single freaking day asking for consolidation loans because they are, up here with that.
Do consolidation loans make sense?
I mean, you're going to either have to refi your loan and combine it into one, depending on how much debt you have on the mortgage, or you're going to be taking a home equity loan or a home equity line of credit. It's better than your credit cards for sure, but you have to be disciplined not to use them again. I mean, if you take a consolidation loan and take a home equity and pay off your credit cards and save all that money, and then you use the credit cards again the next day because now you have all those limits open, shame on you. Like you just lost. Now you're truly just using it as a piggy bank. Your budget doesn't work. But if you're, disciplined and you know what, maybe you got into some stuff because, unexpected debts came up, whatever, and you pay it off one time with a home equity, and then you pay that home equity, you're better off. There's no doubt. I mean, the rates on credit cards are 20, 30% in some cases. The home equities are still sitting in the 7s and 8s, which isn't terrible.
Yeah, and I want everybody who watches this or will watch this to understand that there are a lot of unscrupulous, let's call them scammers out there that are advertising that you can get this money, you don't have to pay it back. That's bullshit. You do have to pay it back. So you got to be really careful there. So when we talk about home equity, are we talking about home equity loans, or are we talking about home equity lines of credit?
There's both. Like, we offer both. I know I'm sure a lot of people offer both. Home equity loan is more of a fixed rate product, and sometimes you'll offer a more advantageous, interest rate. A HELOC is where you can use the money little by little, so that gives you an advantage if you don't need it all right away. I personally like a HELOC type scenario if you're doing a long-term like home improvement project, because that way you can just use the money as you need it, not paying interest when you don't use it. If it's for a loan where you're going to be using it for debt consolidation, I prefer the home equity loan. That way you kind of know where your rate is, and in case like somehow prime shoots up, you're not worried.
Okay, so
in either case, I probably wouldn't refi right now if you're sitting on a 3% rate, because unless that loan is a small amount and you need a much bigger cash, you're not going to sacrifice that 3 and raise it to 7 to refi or 6.5 to refi. So really, a home equity makes more sense to me in most of those cases, as long as it's available to you.
So one of the things I've talked about a lot about with a number of sellers, a number of buyers, mostly sellers, of course, is that they have a low interest rate, and their problem is, as we've talked and alluded to, is that they don't want to get rid of that 3% rate. They would rather keep that 3% rate and stay where they are. What about leveraging that rate to become the investor? What I mean by that is you leverage that rate, home equity loan, whatever, and you keep your existing house as rental income to buy your next home. And what I mean by using the word leverage is the rental and whatever you're going to achieve there, because it's going to probably be more than your mortgage anyway, you can leverage to use for the higher interest rate on your next home.
You definitely could. It depends on obviously the rental numbers on the place. And then also don't forget, since you're going to be borrowing on the second loan, you have to do some sort of cost average on that, with the mortgage and the home equity. But as long as those numbers make sense and you have the kind of assets to be able to put down on the next home combined with that home equity money, absolutely. I mean, why sell something at 3% if it rents, if it's in an area like, Hudson County where, rents are easy to come by right now. Absolutely. And a lot of people are doing it. The ones that are in like, high income jobs that have the kind of assets to put down on their next home. Absolutely. And they are doing it left and right. We're seeing it more and more. It's just, if you don't have if you don't have the assets, it's hard to do, like you can take, in some cases. And the other thing is like planning early is huge. I'm about to, send something to some of my clients, just to remind them, like, if you're even thinking about moving in the next year or two, and you kind of feel like the pinch with your family growing and stuff, you should be having that conversation now, because I'll probably tell them, hey, go get a line of credit on your house now, just in case we need it a year from now. Because if you call me and you're about to buy a house and you need an offer and you can't get a line at that point on your residence because you're about to move out, it's going to be an investment property. So there's, it's hard to come by bridge loans. We're working on some, but it's not an easy product. And so I'll, do it a year ahead, year and a half ahead, get a line of credit on your house for the absolute maximum amount a bank will lend you. So it's there just waiting for you in case you need it. Now, when you're ready to move, like you said, you can use that equity if you want as part of your down payment. And then you can decide, do I want to rent this? Do I want to sell it? You can look at the rent numbers with your real estate agent and, get a good feel for it, but people don't do that. They literally will call us as they're making an offer after 4 years of, not talking. And it's like, no, how can I get, And it's difficult, especially if you own a home now. Like, think about the high rates. It's not easy to be able to afford the current home and the new home on paper anymore like it used to be. So, those are all things that, I always tell people, if the thought even comes into the back of your mind, have that strategy conversation. I'm not saying go out, get a full-on pre-approval, just have a strategy conversation so you know what you have to do. And if there's some things you could do preemptively, do it.
So I want to talk about the strategies and I want to change gears just a little bit. I mean, talking about strategies of real estate professionals working with buyers, working with sellers. I mean, one of the things, I've already learned from you a whole bunch from things that you've talked about, setting up and strategizing with that buyer, strategizing with that seller, whether it's a condo or a single family home. Talk to me about what's important about those conversations, those strategy sessions, and those presentations. Talk to me about that.
So look, I think that initial conversation is important because they have to understand that if it's going to be in a competitive situation, they have to know like what they may have to, give up, what they're going to have to, be okay with. And, we've talked about the big ones, right? Inspection, maybe you have to give up some inspection waiver stuff, where you're not going to nickel and dime for little stuff. You're certainly going to have to give up the appraisal. And that's a tough conversation. And we talked about this the other day. That's not an easy conversation for a realtor to have. And a lot of clients just don't understand what they're giving up and they think it's this massive risk. And for many people, it's not that big of a deal to give that up, but understanding why is important. And I think that's where having a good partner helps, because we can have that conversation a lot easier than a realtor can. One, we're not trying to sell them on anything, and they don't have that back of their mind thought process of, oh, the realtor's just telling me to do all this because he wants to sell us a house. No, it's coming from a totally different third party now. I'm explaining to you your risk.
Great point.
And you just kind of look at the risk of it. Say, look, listen, sir, you got 20% down. If you're giving up this appraisal thing, the highest appraisal differential we've seen in 3 years is 5%, from the sales price. And it's very seldom that it happens. So odds are low. You can give up 5%, and the worst thing that can happen to you is you'd have to pay mortgage insurance on your property if you have a 20% down payment. And that payment comes out to be this. Are you okay with that risk? $50 a month, $60, whatever. And if they say, oh yeah, that's all I'm giving up. I thought I had to bring all this extra money. You don't have to bring a nickel if you don't want, as long as you're willing to pay PMI. And once you have that conversation, it's just easier. So a realtor, to me, I think, one of the things we were chatting about was just, what would an agent need these days? You need a good freaking team. You need to be able to have these consult calls. You shouldn't just be calling your mortgage person and your attorney just because you're giving them a client. No, you should be having these conversations for strategy so that going into that call, you can kind of say to the client why, how, and then explain their risk. Same thing with the attorneys. You should be using your attorneys as leverage too. You need a team, basically, a good one that you can truly rely on.
Yeah, and those conversations, Baret, are so important because they're not only strategy sessions for your client, they're also educational sessions for your client. For them to really, they may think they know about how to do certain things. And it's for you to really, in your conversation, call it a presentation, whatever you want to call it, is for you to really clarify in their heads what they have to do. Like you just said, we talked about, bringing money to the table about appraisal. And I want you to go through that again, simply because it's really, really important, because as a buyer rep or as a real estate agent, you really need to understand what waiving appraisal is going to mean and how the different strategies you can use for that in order to have your best foot forward to get your offer accepted. So
look, there's different cases, right? So if you're talking about a $2 million property and the person has 20% down, if that appraisal comes in, they're going to have to bring money, right? That's a conversation that's got to be had. And in a lot of those cases, when they have that kind of price point, they usually do have it. And we talk about it and we say, look, if it comes in 50,000 low, you'd have to bring $40,000 to closing to lower your mortgage. Are you okay with that? That's the risk you have. And then that's that conversation. But if somebody's putting down, if it's an $800,000 house, a conventional loans can go down to 5% down with the same rates as 20% down. Only difference being mortgage insurance, PMI. So if somebody has 20 to start out, they can literally waive 15% of that appraisal without any worry of having to bring extra money, because they can simply just pay PMI as if they were putting 5% down. It's the same concept. So a lot of people don't realize that. They think, oh my God, I'm making up an appraisal gap. And I see it from the listing agent side. They want to see proof of funds for that extra money. Hey, nobody needs any extra money. All the client has to do in that rider is agree to pay mortgage insurance if the appraisal comes in lower. And all they're doing is, once they agree to that, their risk is worst case that I have to pay this $100 a month for the foreseeable future. So if you can explain, and a lot of times we have to have these calls with the listing agents too, make them understand that this
Just
guy
gonna
doesn't
say
need any
that.
more money.
Just gonna say
Like,
that, yeah.
Yeah, because they're literally asking for proof of funds. We had the case the other day, and we explained it and said, no, look, they qualify for 10% down and 5% down. So if the appraisal comes in low, they can simply just pay mortgage insurance. That's on them. That's their risk. And if it happens, they're willing to move on with the same price, and they're willing to pay the mortgage insurance. And that got them the deal.
When I introduced you earlier, this is the point that I had never heard. You mentioned this earlier in a meeting we had this week, and this is just really key for a lot of people. And you have to have that conversation with the listing agent, because I'm going to tell you that majority of listing agents won't understand this, right?
They usually don't.
And it's really important to see this. And this is how the industry has changed. It doesn't seem like a big deal, and it probably never changed. But now we really need to be cognizant of the fact and really understand exactly how we can maneuver and strategize our offers.
Yep. And the funny thing is, if you knew how many hours I've taken with that conversation in my lifetime, and then the appraisal comes in perfectly fine, but you can't get those hours. You can't get those hours back. But I'm joking when I say it, because look, a client has to feel empowered. Like, they have to know. So we're all about educating our clients. Like, we try to give them all the options. And we'll, if they say, I just want a 30-year fixed, I'm still going to tell them about the other products, because a lot of times once you tell them about the other products, they go, oh, I didn't know it worked that way. So I want them to be educated, and then make whatever your choice you want. I have no horse in the race. Doesn't matter to me. You want to do this and that. And so to me, like, it gives the client confidence going into it rather than fear. And that's where you want your, because if they lose that deal, the next time they know exactly what to do. They're like veterans the next time. And so that next offer is going to go super easy.
Right. And this is the importance of having, not just any mortgage person, just to have the right mortgage person that actually knows what they're talking about, that can really manipulate. That's the wrong word. Strategize the deal. Right. And it's all about your team. And that's one of the things that we've been able to do because of, great people like yourself. When we're talking about, is there a big difference between residential and condo financing?
I think there is. I mean, single family financing is easy. I mean, I hate saying it that way, but it is. Like, you just, you're talking with the client, they're motivated. There's nobody else to talk to. Condo, not only are you approving the client and going through that whole thing, you have to approve the condo. And I don't know if a lot of people realize this. I think most of the realtors in the condo market realize it. But townhouses, in the suburbs, they fall right under that condo umbrella. Right. Co-ops, they all fall into it. They have become really difficult. I mean, this is probably in my 30 years. This is the hardest I've ever seen condo financing. Fannie Mae has really dug in after that incident happened in Miami with the building. And I really think they went way too far on the pendulum, because they're making it harder and harder for things, even on, situations that we used to lend easily on. And so, I'm constantly talking to my condo team, our risk managers, to feel good about buildings, even after Fannie Mae has denied loans at times, or denied a building. Like, they'll literally, cancel a building out until you show them proof that all this stuff that they're supposedly canceling on is done. And a lot of times it's misinformation. They don't have the whole story, but they won't speak to the management companies. So, like, how do they get the story? Like, you have to try to get it in writing, which is not easy. But if they just had a conversation with the management company, they'd probably be fine with the building, just like we are in some cases. So it has become difficult. It's probably I'll say 90% of the deals that end up on my desk because somebody else turned them down are because of the condo. It's very rarely because they screwed up something on the client's income or something. It's 90% of turndowns that I get that I have to come and save are condo related.
So talk to me about the things that are important when working with a condo. What are the details that we have to have? Go through that, please.
That's great question. So, like, if I'm a real estate agent on the listing side, when I'm taking that listing, I think it makes you look extremely knowledgeable, and it helps you on that listing that you know all this stuff and you're thinking outside the box to make sure, hey, I'm not just going to pick up your listing. I'm going to make sure it closes. So you need to help me get this, this, and this. Main thing, right? Is there litigation? Of course, you asked that question. Is there any litigation in your building? Anybody that is somewhat involved would see something about it in their emails from the management company, right? So they should know that. If not, they can ask. The second biggest one, and this is a big one because all these buildings in New Jersey now have to get reserve analysis done to make sure that they have enough money. If they've had a reserve analysis, if they've had an engineer come in the last 3 years, the lender has to have a copy of that report to see what's going on in the building. And so that is a major one. So if you're not asking that question, by the way, do you know if a reserve analysis has been done in the last 3 years? I do not know. Okay, then call your management company and ask. Because if they answer that question with a yes on a condo questionnaire, it just opens up a whole Pandora's box of hell for us. Because now we have to look into it, see what they're calling that it needs to be replaced. see if it's any safety or structural concerns. And like, you're basically turning into an engineer when we're not engineers. So it really does make it difficult. The other big ones, get their insurances up front. There's been a significant amount of insurance changes, requirements that have changed. And a lot of the management companies haven't realized that they're not up on this stuff. And so they have their same policy they've been renewing year and year over year over year. Now there's all these extra like add-ons, like, they want to make sure you have inflation guard, which is, as your policy, as inflation goes up, they want your policy to go up. They have all these little features that they want in these policies. And we have to ask. If they don't have it, now they have to add it. We can't close the loan. And so we're seeing deals like that falling apart left and right with lenders. We have found a couple of workarounds that work, where you can use their own insurance, their interior policy to overcome some of that stuff on the master policy. But it is, like, you really have to get into the nitty gritty. So for me, if I'm the listing agent, I'm asking about engineer or reports or reserve analysis, 100%. I'm asking if there's any litigation, and I'm getting the insurance policies as early as I can. And if there's flood, get both, 100%, so that we can take a look, make sure they have the right coverages. And I can do that up front for someone where they can go in and say, yep, this is good to go. Other things to check, just make sure, obviously, as you're looking at a building, that no one individual owns like more than 25% of the units in a building. That could cause a problem for you later on. Single ownership is bad. And beyond that would be like, if they're running into any financial issues, if they have any assessments coming up and things like that, that's a great question to ask too, because one, you're gonna have to disclose it to the buyer. Two, again, once we know there's an assessment, we're gonna ask why and what they're doing with the money. And do we think that that's gonna be a problem for the building, or if we think it's gonna be any safety or structural issues. So these are all things they've kind of put on the lenders, making it really difficult. And a lot of times it's just gray area stuff that you're making business decisions. And, we've, prided ourselves for years on making these things the right way for people and, being as flexible as possible, but it's definitely becoming harder.
So what's it?
People that don't work in condo, it's really hard because they don't even know the rules. For people that don't work in the condo market, it's like, they're in left field, they have,
So how different is it for the listing agent and the buyer agent? Is there a big difference, or they're going to ask the same questions?
Same questions. As on the buy side, it's harder to ask. I mean, you can ask for this stuff, but if the listing agent didn't do their job, they're not going to have it yet. Like they're going to have to, but that's the same thing on the buy side. Like I would ask, hey, can you find out if the buildings had this? Like I would ask these same questions. Hopefully the listing agent did their job and they know it. But if they don't, they can ask at that time during attorney review, early as possible. So that if the deal's going to die, at least we know it. Or if we're going to have to figure it out, at least we know it early and not last minute. There's nothing worse than chasing down a condo questionnaire over and over again, finally comes in, after 20 days, because that's when they finally get around to it. And we are chasing. It's not like we're sitting on our butt. And it comes in and has one of these things. So now there's 10 days to closing, and this stuff comes up, and it will delay you. There's no question. So what the more you can find out early, the better. We don't even go into a deal unless we know, to be honest. Like I won't fully start a process until I know. Like if I have a good inkling on the building where we did loans there, obviously, we can jump in. But if it's the building I have no clue about, I'll ask these questions up front. I'll call the attorney. I'll call whoever to say, hey, find this out. Otherwise, it's going to be an issue.
All right. So you've got buildings that have all their ducks in a row. They've got all the paperwork done. They got their insurances, and then you have these buildings. In particular, Hoboken, there's 5 units in a building, and it's a condo association.
Right. Yep.
And one person runs the whole thing.
That's right.
Then there's difficulties there. What are people looking for in difficulties of those structures?
Those aren't too bad because the hardest part is getting a condo questionnaire filled out correctly by someone who doesn't do that for a living. So there, you just have to maybe talk to them and do it with them and help them with the questions, make them just understand in English what they mean, and then let them fill it out. A lot of times though, if the buyer's putting down 10, 15, 20%, it's not that many difficult questions. And if they haven't had an engineer or replacement study in the last 3 years, then we really don't have much to ask. And they go through, I actually would almost prefer those than to a 30, 40 unit building right now. They're harder because they have more stuff going on. They have assessments, they have management companies. The 4 or 5 unit guys are just kind of running it themselves, and they usually end up okay.
So can a 4 or 5 unit building, should they hire a management company?
I don't know. It depends on how much trouble it is, how well the people get along. I mean, I think anything over 4 units, you kind of need one, but it's a lot to manage if you ask me. I live in a 2-unit condo here in Hoboken, and we manage it ourselves. I think anything from 2 to 4 units, you can pretty much do yourself. Those are also very easy for financing. Anything 2 to 4 units, so 4 and under, are actually the easiest ones, and there's not a lot of rules and regulations.
Okay, so I want to get to negotiations a little bit. And we
Sure.
talked a little bit about this before when we talked about buyers and sellers and appraisal gaps and stuff like that.
Yeah.
Is there an advantage to a buyer coming in with their best offer immediately rather than starting and waiting for highest and best and all that? In your opinion, is it an advantage or a disadvantage, or it doesn't matter?
I mean, I don't see it as a disadvantage. Like, why play games? If you know you're competing, like I'll have people call me and ask me for a pre-approval that's less than what I've already provided them because they don't want to show the seller their hand. And I laugh because I'm like, you're competing with 12 people, man. Show them the best thing you've got. If you qualify for $1 million, give them $1 million, even if you're offering 800. Show them how overqualified you are at that point, right? So, because you're competing on this, it's not like you're going to try to negotiate. So, to me, I'd come in with my best offer, and then you may have to up it even after that because you never know. Like these days, like you just have to be prepared for it. So, like when we have our initial pre-approval conversations with people in the suburbs and stuff where the market is extremely, competitive, I'm talking to them up front and say, hey, don't be thrown off if you're 150,000 over asking. I say, like, that's the new thing. So, like, they list low so they get eyes on the property. And then, they let the market determine the price. So a lot of times, like, I know it's going to seem really weird to do this. And when your agent's telling you, you're going to think they're crazy. They're not. And this is what happens. And we see it all the time. And it doesn't bother appraisals. Appraisers don't even look at the list price anymore. They look at the comps. And so just to get them comfortable with that mindset, because I mean, it's got to be, disconcerting to, place is listed for 7 and you're paying 880. And it happens every single time. So it's, just getting people understanding that fact. And again, you can tell the ones that have made offers and lost and the ones that are doing it for the first time. The ones that are doing it for the first time are in shock. The ones that have made and lost offers get the whole game already. They figured it out, and they're talking to their agent about the right price.
Okay, so I need you to clear something up for me. When we're talking about 100 over asking, 150 over asking, all this, right? So we talked earlier about the equity appreciation being 3 to 4% or whatever it is. Okay, so we just talked about 100 over asking.
Yeah.
Isn't that more than 3 or 4%? What am I missing about the alignment of those numbers?
I mean, to me, I think the asking price is nothing more than a marketing thing right now for these realtors, just to be able to get as many eyes on these properties, get more people into their open house.
That's true. That's true.
So I think the list price to me is a kind of almost an irrelevant thing. I think properties are still going up. Like I see it. Like last year, people that bought in 2020, late 23, 24, we refied a lot of them this year, and their appraisals were coming in 30, 40,000 higher than what they paid. And they paid 150 over asking and 120 over asking. So it's, I think the asking price and what you go over to me is like almost, you can't even look at it anymore. And I don't think appraisals do. Appraisers aren't looking at it. They're looking at it as, okay, let's just look at the comparables. And most of the comparables will support that higher price. If 8 people are offering all in the same vicinity, it's worth that money, right? Like it's what somebody's willing to pay for it. And if there's 8 offers and they're all in 850 to 900, it's not worth 7,
Right. How do those numbers relate to, the local appreciation numbers of 3% or 4% or 5%? We would think that they might be 20%, right? Or no?
In some cases, you're seeing some big numbers. In some cases, you're not. It depends on where. And
okay.
And I think when interest rates go down, you're going to see prices come up again. If they get to 6%, I really do too. Like I think some of these places that have been kind of stagnant, there's been a few stagnant things. Like, in Hoboken, for example, like you'll see properties that are like really desirable where they're unique. They'll go like that. And then you'll see a property that sits for a while and you don't understand why. It's just your typical, maybe your everyday 2-bedroom, 2-bath. 1,200 square foot. There's a few of them like it, and they'll sit. But then when the rates hit 6%, that thing's going too, and it might even go higher than what it was sitting for all those months, because it just brings so many people into the market that I think you're going to see all those things move. I think the local market has been probably going about 2 to 3% a year, minimally. The suburbs are a whole different animal. There's just so much demand for like a home. Nowadays, especially with everybody not going back to the office full time, even if it's part time, that commute, which used to keep people away from the suburbs, is now less of a factor. If they're only going in twice a week, 3 days a week, they can handle an hour commute 3 days a week to have a much bigger home because they're just, bursting at the seams in their condo. I'm talking to a lot of people who are fed up, basically, like fed up with their condominium living. They're like ready to kill each other. They hate
that's what I said. That's what I alluded to earlier. Like people are going to move. I mean, look at. I'm going to use an example, which probably won't make sense to some people, but look at the changes. I mean, I think more and more companies are bringing people back to the office.
They are.
I mean, look, if Starbucks can now put the cream out and they don't put the cream in your coffee anymore, like they did during COVID and after, all this is going to change, and we're going to get back to maybe pre-COVID and how we did stuff. That doesn't mean prices or interest rates are going to be there. You know, I just think it's funny where it's like I hated when they put cream in my coffee, and then I hated it now going back. So, and it's the same thing with going back to work, and that all relates to housing, all relates to mortgages and stuff. I think
people abused it a bit. I think people abused that whole thing too. Like, I think there were people working out from home that could have easily gone to the office. And, now that companies are doing it, I'm kind of happy. Like, I've always been a work from the office guy. Like, my entire team, if you're on my personal sales team, you have to come to the office. That's part of the rules. I've made one exception, and that's been because we can make it work a little bit with technology now. But overall, like, I want to see everyone. It's just easier. You feel the energy, and everybody feeds off each other a lot better. But I don't believe in the work from home concept. I know some people do. Certain industries, maybe it's different. In ours, I wish even more people came to the office.
Yeah, I can't work from home because the refrigerator is here. So I mean, it's difficult. It's a distraction.
Yeah.
We're now bringing everybody as much as possible into the office as we can. Being a cloud broker is a little difficult sometimes. We don't have offices everywhere. I want to ask you a few questions. I want to go through certain things and just get your responses to them. When you're going to buy a house, is there an advantage or a disadvantage? And tell me how you do it to borrow from your 401k.
So borrowing from 401k, you could take up to 50% or 50,000, whichever is lower. I personally love the idea, especially if it's a short-term thing. Like, I'm going to sell my house after closing, but I can use a little extra cash for a down payment. It's the perfect place to borrow because the interest is going back into your own account. So regardless of the interest rate, it's flowing back into your own 401k. It's just that's why they put such limits on it. If people could borrow 500,000 from it, they would, but they cap you at 50. So that 50,000 to me is a gimme. I would take that every single time if I needed to get to a bigger down payment to make my offer more competitive. I think it's a great idea.
Okay, so answer this question for me.
It's as good a bridge loan as you're going to get. You're paying yourself back, and you're not paying upfront fees.
But isn't that another loan on your credit?
It's not a loan on your
borrowing
credit.
it?
No, it does not go against your debt ratio. So we do not count any loans against your assets in your debt ratio, because you can simply just take the money out, pay taxes, and call it a day. So because of that optionality of not having to pay it back, you do not have to count that as a debt against somebody's monthly payments. You do have to pay it out of your paycheck monthly. It does have to flow into your own account, but beyond that, it won't hurt you in our world. Same thing if you borrow money from your investment accounts. So there, you're less limited. If you have $500,000 in a Fidelity account that's for mutual funds, and you just don't want to sell because you don't want to get hit with all the capital gains, you can just borrow against it, and we won't hit you for the borrowing cost because it's against your asset. It can be liquidated any time. And therefore, it's a perfect way to do it without having to get hit with the capital gains, especially if you're about to sell a home right after and pay it all back. So these are the best places to get a bridge, in my opinion. Your own assets, 401k.
Let's segue into investments. Let's segue into, say you've got, $500,000 stock portfolio, and you want to borrow against that. Okay, two-part question. You want to borrow against that to buy a residence.
Yep. Easy to do. You can take, usually most investment companies will give you a margin loan up to about 50 to 60% of your portfolio, depending on what kind of investments it's in. So 250, 300 on that 500 could easily be taken. And then you'll pay interest on to the institution. But if that's a great way to borrow money and not have to pay a bunch of upfront fees on it. And therefore,
does that work against your debt ratios?
Does not. Once again, anything against your own personal assets other than a home equity loan. Like if you take a home equity line of credit, there we would have to count a payment against you. But anything against your assets or anything against your 401k, you're good.
Okay. So part two of that question is, what about for an investment? Say you want to buy a two-family.
Yeah, same thing. I mean, you have to think so if you're going to buy an investment and you don't even have the down payment cash where you have to borrow that from your investment account, and you look at the overall interest you're paying now to your investment and then also on the actual mortgage, and are the rents going to be able to cover that? That's a very difficult thing these days. I got to tell you, it's hard to break even. If you don't have some of your own cash in the transaction, it's just hard to make the numbers work. But can you do it? Absolutely.
Okay, so not a problem. Okay, good, great. I'm glad we
absolutely do it.
All right, so contingencies in sales, like for instance, a sale contingency for a buyer, a sale contingency, a buy contingency for a seller. Talking about how those work in your world.
You definitely don't want them. I think it makes the purchase on the new side difficult. So you try to do everything in your power to not have it contingent. We have a couple of ways to get around it. We have a bridge scenario through a company called Nat'l, where they will literally, if offer to buy your house in 6 months, and they'll also give you a bridge against it, but it's going to cost you. You're paying, 2.25% on the price of your current house to this company for the privilege to be able to say you're not contingent. Because by them offering to buy your home with no contingencies, we don't have to count the departing residents anymore. And they'll give you a bridge against it, so you'll actually get down payment money. So if you have no other way to waive your contingency, something like this is great. If there's any way you can carry the 2 payments and borrow from your own money, 401k, or some other way, obviously do that, because that'll save you a ton of money. But otherwise, there are companies out there who will basically guarantee buying your home so that you can qualify without a contingency, but they're not cheap. So if you end up needing them at closing, 2.25% of your freaking sales price on your departing residence is no joke. $1 million home, you're paying $22,000 for that privilege. But it's really hard to get a contingent offer accepted these days. So we try to find any possible solution. You can rent your departing residence and decide, hey, you know what, I'm going to rent this place, and you can actually get a legitimate lease on it, security deposit, all that, and rent it during the process, and that's no problem. We'll count the future rent against the payment, and then make the numbers work that way. But you still need the down payment. So the people that are waiving contingencies are your high income earners. They have a really cheap current mortgage because they got a great rate. It wasn't a huge amount, and they have the type of income to carry both, and they just happen to have enough assets to make it work. Keep in mind, you don't need 20% in a lot of instances. 10% does it. And then that gives you plenty of time to sell your house, and you can always pay down the mortgage and then recast it or whatever just to get your payments down. So all you really need is like 10% on the new house, and you have to have enough income to be able to carry both, and you can waive a contingency. It's not like impossible, but it's not easy either. Somebody's sitting on a $2 million house in Hoboken and they want to buy a $2.5 million house in Westfield. You got to carry $4.5 million in mortgages. You can make a lot of money and still not qualify for that. Right. So that there are some, that's why I say like a year ahead. You never want to do this last minute where we're figuring this out as you found your perfect home in Westfield. We want to do it ahead of time so I can talk to you and say, listen, you got to be ready to sell your home like earlier maybe. Consider selling and renting because you don't qualify without a contingency. You're never going to find a place, So maybe consider selling your home. And as painful as it is, rent a place for a year. You have your cash sitting with you, and then you go buy a place next year. But there are strategies like that we have to talk about. So it's never good to do the minute up.
Let's jump back to something else. Talk to me about what's available and how it's done with down payment assistance.
There's some state programs available that I don't love. I mean, New Jersey first-time homebuyer programs. If you're, first generation in New Jersey, you can get up to about $22,000. There are some income limitations on it. I think, generally in that 130, 140,000 max range. So it doesn't, open you up to tons of other properties. And then the worst part to me of the program is that if you want to refinance, you have to pay the whole thing back. So it's a loan. So it's kind of like but you have to pay the amount back. And how do you do that? If you don't have to pay that, you have to pay that back. You're not going to want to keep paying 7-something%. And a lot of those programs are aligned with FHA. So now you're paying some upfront fees to HUD. I'm not a big FHA fan, especially if somebody has great credit, because you're paying an upfront fee of almost 2% to HUD. And so if you can just scrunch up 3%, you can get you can get a Fannie Mae loan with 3% down. And to be honest, man, if you don't have 3% to put down, don't buy a house. Like I'm being honest, like you shouldn't buy a house. Like you're too tight. Like you should be continuing to save. 3% is not much to ask. And that's all it takes to just get a regular conventional loan without all the hoopla.
Okay. So I got a really crazy question for you.
Yes, sir.
Last question before we get to the end. We're running up against time. What is and who is the wrong lender?
I think there's a lot of people out there that are just kind of desperate right now. And I don't think they're giving necessarily the best advice for people. Maybe they're giving the best advice for themselves. And we see it in our industry. And, some of them are taking major risks and, committing fraud and things like that. And really what people don't realize is when they're committing fraud on their end, you're committing fraud. They're talking you into it. Maybe they're explaining, but you're committing fraud. You're actually on the firing line there.
Yeah.
And, we've had some things recently in our industry that shook it up pretty good with some top people in that situation. And, it just, if you end up in a situation like that and you're part of it as a real estate agent, God, you just don't do it, man. It's just so stupid. There's enough ways to work around stuff that are within the rules. And if it doesn't work, it doesn't work. You got to walk away. I think that's the worst ones. The guys that are like, really on the cusp of like fraud on every deal.
Yeah, you have to be really careful. I mean, look, I want to tell everybody that this is the guy to talk to if you're looking to invest as a new investor. You want to buy a house, buy a condo. Baret is like I said, he's got the answers. He's got the questions for you as well. And Baret, before we finish up, I have two things. One is a question. One is a comment. First question is, how do I help you grow your business?
This was great for me. Like I love coming on and having these conversations. For me, we talk, with the Align group all the time. I love working with that group just because I feel like there's so much training. There's so much, knowledge that's being passed on from the top leaders to everyone that's on that team. The more you can kind of, give us a shout out with those guys to realize like, hey, we can be their partner and really help them on our side. That's all I can ask. But I love the way that group does it. And as a new agent, if you're brand new coming into this business, man, you definitely need a team concept. It's not easy to be a lone wolf in this current market. Make sure you join a great group that has the kind of training and the constant just information sharing. That's really important.
Yeah, great. Thank you so much. And last but not least, everybody that comes on a broadcast, Baret, gets
yes. That's what I'm talking about. The only thing I'll say is I'm gonna have to break that thing in pretty good. For me, unless that hat looks like it's been through it, I'll have to take that thing down a couple of cycles in the washing machine. But that thing's gonna look nice.
All right, man. Hey, look, I want to thank everybody for coming on. Next week, if you put that up, next week we have John Reyes. John Reyes is a friend of mine. He is the CEO and president of Social Networks. He's a national trainer, a marketing strategist, and an author. I've known John for about 20 years. And he is a great guy, full of information about marketing and everything else for the real estate agent. Baret, thank you so much. Your Instagram is on the screen. Your contact information is on the screen. Thank you so much for being on. I'm looking forward to doing more business with you and doing business with you, period. Thank you so much.
Appreciate you,
hey,
Dave.
everybody.
Yeah,
thanks, everybody. Just stay on for a minute as we go off. And Nelson, hit it.
Hey.